Hi there. If you've ever had this situation where price reaches your market zone, but you're not sure exactly when to enter the trade, this video is exactly for you. Today, I'm going to solve the problem of entry confirmation once and for all, especially if you trade with styles like RTM or price action, and you're looking for a reliable confirmation. So before we get into the main points, if this is your first time here, make sure to subscribe to NEERSOD. And if you find this video helpful, don't forget to like it. Now, let's get to the point. First of all, you need to know, when price enters our zone, it doesn't automatically mean we should enter a trade right away. That's just a potential area. But what turns us from watching to taking action is the entry confirmation. When price reaches our zone, there are 5 strong candlestick patterns that can give us an entry signal. Before anything else, remember that these candlestick patterns work best on the 5-minute or 15-minute time frame. It depends on your style, but in my opinion, the best is 5 minutes, so your stop loss doesn't get too large. You can also enter based on the 1-minute chart, but that has its own risks and requires a different approach. If you want to trade safely, the 5-minute chart is the best for confirmation. Pin bar pattern. This candle shows the market tried to go in one direction but failed, and handed control to the other side. What does that mean? Let's go to the chart and I'll show you with an example. I'm on the 5-minute chart. As you can see, price dropped with momentum to this zone. On the upper zone, we had a pin bar candle as well, but the reason we shouldn't have entered there is because, as seen on the 1-hour chart, price was dropping sharply and had already reacted to this area multiple times, even collecting orders below the zone. So it was risky to enter there. It would have been better for price to consolidate longer in that area, so more buyers could step in and outnumber the sellers. Eventually, price passed through the zone sharply on the 1-hour and closed below it. But the lower zone was more valuable. Even though price was dropping with momentum, it still closed above this lower zone. And as you can see, this was only the second touch, and enough orders hadn't been collected yet, so it was worth the risk. Now, in this zone, we have a pin bar candle with a shadow 2-3 times longer than the body. And next to it, we have a Doji or indecision candle, both with lower wicks. That means price wanted to drop, but buy orders pushed it back up, and buyers entered the market. So this zone is worth taking the risk. After this candle closed, we could have entered the trade, which gave about 70 pips profit.
As you can see, it gave a second entry too. So if you missed the first one, you could enter here. But there's one thing to keep in mind. We had a demand zone here that was broken, so it could now act as resistance. As long as this resistance isn't broken, we can't expect higher targets. As you can see, price first dropped from it again, gave a re-entry, and the second time it closed above that zone. After giving us 70 pips, price reacted to the 15-minute low and dropped again. So always remember, trade management is key, and once you're in a trade, don't leave it unattended. By the way, these 2 candles also formed on the 15-minute chart, so it didn't make a big difference whether you entered on the 5 or 15-minute. Important tip, the direction of the wick matters a lot because it shows which side the orders are coming in from. If price is in a demand zone, the wick should be downward, meaning buy orders are entering and stopping the drop. If price is in a supply zone, the wick should be upward, meaning sell orders are entering and stopping the rise. If a pin bar doesn't form in a specific zone, it's not reliable enough to risk a trade. You can't enter a trade just based on a pin bar anywhere on the chart. And if the next candle completely retraces the wick of the pin bar, then the setup becomes risky, and you should either reduce your position size or fully exit. Engulfing pattern, a candle that completely covers the previous one. We say it engulfed it. This means the market decided to fully reverse the previous move. As you can see, price entered a supply zone, a green momentum candle formed, but then a strong bearish candle followed, showing sellers aggressively entered the market.
so we can justify taking a sell trade. Price dropped 150 pips. Piercing pattern, a softer version of the engulfing. The new candle should cover more than 50% of the previous candle. It shows the market is still uncertain, but it's a first signal of reversal. If a stronger candle comes right after, the signal becomes more valid. For example, take this part of the chart. Price entered the zone. Range candles and pin bars were seen, but then the stop loss hit and price went higher, reacting to static resistance. There, a pin bar formed, led to a drop, and price came back to retest it. Then we got a piercing pattern, followed by a 300 pip drop. One thing about the engulfing and piercing patterns, if the next candle negates the move, the setup becomes risky. For example, if after a bearish confirmation candle, you get a strong bullish candle right away, it makes the setup unreliable. Trigger line. This confirmation is useful for traders who like more technical entries. When price reaches an important zone, connect the recent highs and lows with a line. If this line breaks, or if price pulls back to it, that could be your entry point. The stronger the candle that breaks the line, the higher the chance of success. Here, instead of just candles, we're using price behavior and market structure. Basically, we're watching for short-term resistance breaks. For example, look here. Price enters a supply zone. We have a low and a high, followed by a higher low and high. We connect the lows with a trend line. As you can see, once it's broken, we can enter a sell trade. And our final pattern is the Doji confirmation. When price enters a zone and you see a Doji candle, it means the market is undecided. If the next candle is a momentum candle, that means the market has made its decision, and you can take the trade. For example, look here. Price enters a supply zone. A Doji forms, showing indecision. The next candle is a strong bearish momentum candle, meaning sellers have won, and it's safe to take a sell position. Remember, confirmations help us stay out of noise and only enter trades when the probability of success is higher. If you like this type of content, leave a comment and tell me which style of analysis you prefer, and I'll cover that next.